Today we're going to ask a question no one else seems to be asking. How do you accidentally give away $3 billion and why does it keep happening? Please remember, I'm not a licensed financial advisor and the content provided is for educational and entertainment purposes only. Figma, the design software startup you've probably heard about, just went public. Shares were priced at $33. Within hours, they were trading at over $115. That's a 250% jump, one of the biggest in the recent memory. It was historic. But here's the kicker. That 250% pop means someone left billions on the table. Specifically, Figma and its selling shareholders lost out on around $3 billion they could have had if they'd simply priced the shares closer to the market value. So who got rich? Who got burned? And why are we pretending this is normal? Bankers love to say that IPO pricing is an art, not a science. Translation, it's a guessing game that somehow always favors the institutions. They say they aim for a modest 20 to 30% first day gain. That's supposed to show enthusiasm without looking like the company got robbed. But 250%? That's not enthusiasm. That's insanity. That's Wall Street misjudging demand in a way that would get anyone else fired. Unless, of course, the people they really serve made out like bandits. And make no mistake, they did. Figma co-founder Dylan Field walked away with over 77 million in cash just from the IPO. And he still owns a stake worth 6 billion. Venture capital like Sequoia and Greylock, they sold shares, sure, but they held on to the most of them. They'll sell later at those inflated prices. Smart. Meanwhile, the Marin Community Foundation, a nonprofit that sold all its shares in the IPO, made 440 million. Sounds great? Until you realize those same shares would now be worth 1.5 billion. That's $1 billion miss for a nonprofit. And nobody warned them. Now, let's look at the broader trend. This is not just a Figma problem. It's system. Just a few weeks ago, Circle Internet Group, yes, the stablecoin company, doubled on day one. That's 1.8 billion left on the table. Snowflake in 2020, same thing. Over 3.7 billion could have been raised if the shares were priced accurately. Instead, it went to buyers who got the IPO allocations, not the company, not the founders, not the mission, the insiders. Why does this keep happening? Because Wall Street is not built to reward fair pricing. It's built to reward control. Bankers talk to their favorite institutional clients, not to the retail investors who now dominate public sentiment. And those institutions often refuse to pay above a certain price. So bankers cap the IPO and retail buyers pile in when the stock hits the open market, triggering a massive spike. It's artificial scarcity meets blind optimism. Figma only floated about 7% of its shares, far less than the typical 10 to 15%. That's textbook supply manipulation. The less you sell, the more exclusive it feels. But exclusivity is not a business model. It's a hype tactic, and it worked almost too well. By noon on opening day, Figma was one of the top 5 most traded stocks on Interactive Brokers. A buying frenzy, a tech IPO mania straight out of the 1999. Only this time, it's driven by TikTok traders and AI funds instead of Yahoo chatrooms. And the funniest part? Everyone saw it coming. Analysts knew Figma was hot. It's in the right space, AI, design, digital collaboration. Its tools are essential to modern teams. But still, they lowballed it. Why? Because when insiders win, no one asks questions. And when retail buyers get crumbs, they're just happy the stock went up. That's not capitalism. That's a casino. So what's next? More IPOs are coming. Stripe, Databricks, Canva, these are billion-dollar behemoths just waiting to go public. The big question is not whether they'll go public, it's whether they'll get robbed blind by underpricing too. Will bankers keep playing it safe for institutions while sacrificing billions in capital? Or will someone finally call out the game? Figma's IPO was not just a success story. It was a case study in how a broker system rewards gatekeepers over builders. If we want real innovation, real competition, and real fairness in markets, we need to start pricing companies like we believe in them, not like we're afraid of their potential. Subscribe, stay alert, and follow the money, because next time a successful IPO happens, ask yourself, who's celebrating and who just got played? See you next time. Bye-bye.